our next guest has mapped out his strategy for 2012, 4 themes and 11 stocks. Garry Evans is HSBC's Global Head of Equity Strategy. Garry, great to have you with us. I just want to start with the situation in Europe because it is foremost in all of our minds. You say that there are 2 potential outcomes here. Just outline those for us.
Yeah, I think it's binary, basically. You know, you could imagine a very nasty scenario in which the Eurozone is threatened with collapse. That triggers a credit crunch. We have a severe recession globally because of that. And maybe that's enough to trigger the alternative outcome, which is that Germany gives up its taboos about having stability bonds. The ECB says, OK, there's no alternative but to print money. And I think it makes it very difficult for investors because ultimately it's down to what politicians do. Very hard to forecast that. You know, do they go one way or the other on that? And I think people have got a little bit too blasé, a bit comfortable about the fact that last year we solved the Eurozone problem. I was in Germany yesterday. Nobody is worried. There's a lot of events in the next few weeks, next couple of months, that I think could push us in one of those 2 directions.
One of those 2 directions, but you haven't mentioned the possibility of a breakup of the EU.
I mean, that's the worst-case scenario. I mean, I think in the end, if we do have a crisis, then Germany says the choice is between the end of the euro or us giving in on these things like ECB printing money. They probably choose the latter. But we need to go through a crisis before we get to that decision
point. We need
point.
to hit rock bottom first,
right.
And we're not there yet.
I don't think we are. I mean, valuations are pretty cheap, but if you look at, say, price to book, which is the best valuation in a nasty market, we're still somewhere around about 14%, if you exclude banks, which are a bit of a special subject, about 14% above where we were at the bottom in March 2009. So it could be more downside.
When it comes to stocks, overall, worldwide, you don't expect them to do very much at all in 2012. You think we might see upside of about 2%?
Yeah, so we think very volatile, still stuck within the trading range that we've been in for the last couple of years. So if we have ups and downs, sort of end the year probably where we started is our feeling.
This is a more negative view than other banks. Why?
I think partly because of our views on the economy. So we're looking for the Eurozone to have minus 1% GDP growth this year. And if you look at what analysts are forecasting, which is 10% earnings growth in Europe, in fact, every region around the world, that seems to be much too optimistic.
Which is roughly what we saw last year, correct?
It's what we saw. We didn't see in Europe last year. We saw minus 4% last year in Europe, but we saw 10% roughly globally. So last year we had 10% global earnings growth, and equities still fell 9%. So the question you have to ask yourself is, do you see a further derating of equities? Does risk aversion rise? People get scared about equities and pull their money out. I think there's still some risk of that. And then just on the growth, for the US, the consensus is for about 2.1%, 2.2% GDP growth this year. We've only got 1.5%. So that's one major reason why we're perhaps a bit more pessimistic than the consensus.
Okay, so with all of that in mind, you've chosen 4 themes. Your global equity team has chosen 4 themes to guide investors this year. Just take us through those.
So what we really did was a sort of bottom-up exercise. We asked our analysts to go through their sectors and say which stocks did they think would outperform, what type of themes would do that. And we wrapped all that together, and there were 4 threads that ran through it. So the first one was what we called earnings resilience. Now, I mentioned that earnings forecasts are too high. We're going to see downgrades. What you should prefer is companies that are able to buck that trend. So either they're restructuring, cutting costs, or maybe they've got some, for example, after-sales revenues. You know, if you've built something and you've got sales coming in later, that doesn't disappear in a recession. Second one is what we call long-term structural growth.
Right.
So you want companies that have got great businesses, maybe brands or franchises that are growing market share, that are not too cyclical. Third one is we think there's a fairly significant risk of a credit crunch. European banks in particular will be cutting their assets. They need to raise a lot of equity. They won't be able to do it. What they do is reduce risk-weighted assets. So it's going to be hard for companies with high gearing or with big borrowing requirements to borrow money from banks. So you need to look at companies that have got decent balance sheets. And then the fourth one is simply that there's a lot of very cheap valuations out there. Mispricings, if you like. Correlation of stocks is very high. So everything moves together, which means that some stocks are left very cheap. So I wouldn't put everything into a value basket, but in this sort of world, to sort of leaven your portfolio with some value stocks, I think makes sense.
Now, overall, you are overweight emerging markets in Asia, energy, materials, and telecoms.
Yeah.
Just elaborate on that.
Yeah. So essentially, we take those same themes and we apply them to stocks and countries. So what it really means is you want stocks and sectors and countries that are, A, quite cheap, so we look at valuation. Secondly, you want this resilience on earnings, so we look at relatively low risk of growth surprises being negative. And thirdly, you look at the long-term story. So emerging markets, I think, ticks that quite well. You've got a position where in India or Brazil or China, the long-term story remains good. They've got strong domestic demand, so you're not going to see earnings being slashed. You know, I look at, for example, China. Earnings growth for Chinese companies forecast this year at 10%, exactly the same as Europe. Surely there's more risk for that being downgraded in Europe.
Gary, I just want to show our viewers some of the stocks that your global team has come up with that fit into these 4 investment themes. I just want to kind of run through them. I know you don't want to talk specifically about each one, but let's just kind of give our viewers a feel. We've got Costco Pacific, the shipping containing services company. We've got Rolls-Royce, also Walmex, which is effectively Walmart in Mexico, Brazil Foods, Saipem, which is a construction onshore drilling company in Saipem in Italy. You also have Richemont, luxury, Morrison, the supermarket, Rio Tinto, Total.
Right. So I think the themes run through those. I mean, so, you know, to dig down a bit more, and I can't talk about the individual stocks, so we have to put up all sorts of compliance disclaimers if I do, but you know, there's a couple of stocks in there with decent dividend yields. I think that is still a theme. It's not a new theme, I'd admit, but, you know, if you look, for example, at the energy sector globally, you know, particularly in Europe, you're getting stocks there with 6-7% dividend yield. You know, in a world where risk-free assets, if there's such a thing anymore, government bond yields are only, say, 2-2.5%, that surely looks quite attractive. So I think all the names that you put up there are all good quality companies. A number of them look very cheap. So that's the sort of thing that you're looking for.
Interestingly, no utilities. Those are out this year.
Yeah, and I think it depends a little bit. So we're a bit more optimistic about European utilities, which were really out of favour last year. There was a risk that they were going to be taxed. We think that's probably in the price. But globally, utilities, for example, in the US, we think still look quite expensive. And they're quite well owned. Investors piled into them last year.
Okay, Garry Evans, HSBC's Global Head of Equity Strategy. Thank you very much for visiting us here in London.